Good morning, good afternoon, good evening, peace and love. My name is Blest Norris. I am a licensed financial consultant here in the Boston area. I wanted to take a couple minutes out of your time and just share with you a solution that I think is very impactful for you. And you definitely need to learn a little bit more about this solution here and how fixed index annuity can be added into your retirement portfolio to really strengthen your portfolio and make sure you have the guarantees and safety that you deserve. All right. With that being said, I want to make sure I get this in under 5 minutes. So we're going to blast through as much as possible. So that way you get as much information as you need. And if any questions, you can always reach out to me. So let's get into it. So first and foremost, the importance of the company is very, very key, right? Athene is very strong, great asset, and one of the great things about them is they focus on the annuity space and not so much the life insurance space. A lot of companies do life insurance and also annuities or PNC life annuities. They focus on annuities, and that's why they're so great at what they do in terms of that solution. Now, obviously, we know the pain that is going through in the community. Maybe you're facing it, maybe you're not, but you know someone who's facing these pains. A lot of people are uncertain as to what's going on in their retirement portfolio, and it's because we have been climbing Mount Everest from 20 to age 50, working our butts off, and now at 50, we're coming down a hill and now we're descending. And where does most injuries, death happen on Mount Everest? Is on the descent. Same thing with your situation or your family situation or whomever it may be. The biggest headache that you may have is when you're coming down that hill, going into retirement. Now you need to make sure you have the growth and the protection that you need. And that's where Athene's agility delivers. Okay. With multiple strategies that you can use, I will show you that in the future. And how they deliver is pretty simple. Okay. What they do is protect the downside risk and also give you all the upside mobility, right? Now, with that being said, you will lose some of the upside momentum as you see here in 2020 when COVID happens. But if you take a portion of your income or your retirement portfolio and put it into something like this here, that is the core foundation. You don't care about the 20, 30, 40, 50% returns. You want to make sure you have the stability because on that 20, 30, 40% return, you also have the ability to lose whatever you may have in that account. So you need to protect yourself. And the way Athene does this is by having a few factors that come into play. Okay. What are those factors? Your initial premium will get what we call a benefit based bonus up to 45%. All right. You put 100,000, they add 45,000 on top of that, plus whatever interest is credited to that benefit base minus any withdrawal that you take out of the account. That's going to be your true benefit base to take monies out of when you start getting your retirement paycheck. Now, those benefit base will also increase while you're receiving your paycheck by a certain percentages as you go through, and I'll show you that as well. Okay. Now, there's a few things that most of us want to make sure we have, and that's just the guarantees of life. We want to make sure we have our income coming because, like you're doing now, the main reason why you're working a 9 to 5 is for what? It's for security of a steady paycheck. Why not put that in place for you? Take a small portion of your capital, 20, 30, 40%, to use to protect yourself, to give you the same income that you would have if you were working. And then the extras is just you can take a little bit more chances and do more investments with that. I'm not going to spend too much time on these areas here. There are some key things, but if you want, the information will be in the description below so you can see it. Now, when it comes to interest crediting, there's a few different metrics. What I would like to do is just keep it simple. I'm going to focus on one, and that's going to be the AI Power Global Opportunity Index, right? If you look at this here over a 2 year period, let's just say it does 10% each year, right? Over 2 years, so that's 20%. You're going to get 135% of 20%, which is going to be 27%. I don't know about you, but I'll take that any day of the week. On the 1 year point to point, you will get 100%, which means 10%, right? Now, you do have just straight, caps and floors, but participation rate is very cool because you get more than what you would normally get in a traditional account, and you can mix match this however way you want to do it. You have to be 80. Well, you have to be under 80 and above 40 to be able to get this solution here. If you have a trust, you can do so. There are certain rules and regulations that's in place with the trust. Obviously, you can put as little as 10,000 up to a million If more, the insurance company has to approve it. You do have the ability to withdraw up to 10% of the accumulated value per year. Just keep that in mind as well. And there are some things in place where if you do get sick, you have the ability to withdraw your money and also a death benefit as well. Now, with the income and death benefit rider, like I mentioned before, you get that 40%, 45% bonus on your monies, and also the crediting method or the increase, the roll up is based on 200% of the index, and I'll show you that in a little bit. And your income payment option is based on the earned index income, meaning you will earn more based on how the index perform, which is very, very cool. Okay, you have to wait a minimum of 10 years to start accumulating monies or start taking your lifetime income from this here. And the main reason why the insurance companies just want to give them a little bit of breathing room so it can accumulate a little bit more. Okay, states that this doesn't apply in New York, and also the District of Columbia is another territory that does not have this solution there. Okay, now quick example and we'll be done. Okay, 50-year-old female or male want to retire at 65, have $100,000 they want to play with. They have $250,000 in that 401k plan, doing 7% growth per year, but they want to move over 100,000 to the FIA and keep 150 into their 401k plan to grow. They speculate that they're going to have $1,500 in monthly income coming from Social Security. That's great. Now, the option is they can choose to just keep in the 401k plan, grow at 7%, and they're going to be around $700,000 by the time they're 65 because we have another 15 years, right? So that's one option. Now, if they do that, that option will be this year. They will have $1,500 coming from Social Security plus $22.99 from the 401k plan. Now, you may ask how that happened. Just take this number here times 4%, which is the 4% rule. If you don't know it, please Google it. And that will give you the annual amount. Take that divided by 12. It will be approximately this number here. So if you stay with what you have without implementing this strategy here, you will have about $3,700 a month coming to you. Great. Now, there's no guarantees on that. The market could really hurt you and you can lose it. For example, my uncle, he had similar to this amount in '08. He lost it all. All right. Now, if he would have put this protection in place here and he still has his $1,500 in Social Security, now what he has is the $25,000 divided by 12. He has $2,100 coming from the FIA. So you take this plus this is equivalent to what he will have here and is guaranteed because the Social Security income is an annuity and the FIA is an annuity. So you have two annuity products that's giving you the base foundation, and then whatever happened with your 401k plan, that's a plus. Now taking 150,000 times, you know, times 7% over 15 years, you would get this math here. That's 32% more income in year one. Now, let's look at it. Remember, as we said, 100,000, 45% bump, 4.5% interest rate, you get 200% of that every single year. Your base is going to increase. When you reach your retirement age, when you start taking monies out of your account, you can get 4.85% of the amount you have in there, which is 25,000. But every single year after that, if the index performs and does whatever rate it performs, you're going to get an increase in your retirement income for that. If it does 5%, you get a 5% increase. If it does 2%, you get a 2% increase. That is pretty cool because that is adjusting for inflation. And that is a pretty powerful tool that you have access to. So with that being said, if you have any questions and you would like to learn more, all you have to do is just visit my website, all right, and click book call. And let's set up a time where we can go into a little bit more and see exactly how we can set up a plan for you and see if this may be a good solution for you. I am I have a team of individuals. You can call me or email me as well. That we actually work in these different areas here. We really truly want to make sure we're helping homeowners and making sure everyone is protected and safe. Not only homeowners, also regular individuals. So we want to make sure everyone in the community is protected. And that's what we want to empower the financial future of others and make sure you are protected. So with that being said, if you have any questions, you can actually leave a comment in the below. If I miss anything or said something wrong, please comment it below because that helps us improve and get better. With that being said, I hope you have a wonderful, wonderful day, and I look forward to hearing from you. If not, God bless and take care.